Why investing is 80% psychology. What if I told you that the biggest threat to your investments isn't inflation, recessions, or even stock market crashes? It's the person staring back at you in the mirror. Think about it. Two people buy the exact same investment on the same day. 10 years later, one has built real wealth, while the other has lost money. The difference usually isn't intelligence, it isn't education, and it certainly isn't luck. It's psychology. Today, we're diving into why investing is 80% psychology and only 20% knowledge, and understanding this one idea could completely change the way you build wealth. Most people believe successful investors know something everyone else doesn't, but history tells a different story. Legendary investors didn't become wealthy because they predicted every market move. They became wealthy because they learned to control themselves. The stock market is less a test of IQ and more a test of emotional discipline. Imagine this. The market suddenly falls by 30%. Headlines scream, social media predicts financial doom, and your portfolio is covered in red. Your brain instantly shifts into survival mode. Fear takes over. Every instinct tells you to sell before things get worse. Ironically, this is often when disciplined investors quietly buy. That's because our brains evolved to avoid danger, not to build wealth. Behavioral finance calls this loss aversion. Research consistently shows that losing money hurts us emotionally much more than gaining the same amount feels good. It's why many investors panic at exactly the wrong moment. Then there's greed. When markets are soaring and everyone seems to be making easy money, another emotion appears: FOMO, the fear of missing out. Suddenly, people start buying investments they barely understand, simply because everyone else is doing it. History has repeated this pattern through countless market booms and crashes. Whether it's internet stocks, cryptocurrencies, housing bubbles, or meme stocks, human psychology hasn't changed. Here's the surprising truth. Investing isn't about finding perfect investments. It's about consistently making good decisions while avoiding emotional mistakes. Patience is one of the rarest investing advantages because it can't be downloaded, purchased, or copied. While others chase quick profits, patient investors allow compound growth to work quietly in the background. Wealth often grows slowly, then suddenly. Ask yourself this: if you couldn't check your portfolio for 5 years, would you still invest the same way? That's a question that reveals your mindset more than your strategy. The best investors don't eliminate emotions, they recognize them. They create systems instead of relying on willpower. They diversify, invest consistently, ignore daily market noise, and focus on decades rather than days. Over time, these small psychological advantages become enormous financial advantages. So before you search for the next hot stock or secret investment strategy, spend some time understanding the investor in the mirror. Mastering your emotions may be the highest return investment you'll ever make. If today's conversation changed the way you think about money, let me know in the comments. What's the biggest psychological mistake you've made while investing? And if you're passionate about the psychology of investing, wealth mindset, and long-term financial success, subscribe and join us for more conversations that help you become not just a better investor, but a wiser one. Until next time, remember, markets will always test your portfolio, but they will test your mind first.